Hey guys, Bitcoin once again makes the market sit up straight. The move isn't extreme, but there is a nerve running through the tape. I'll go on order unpacking the most likely near-term scenarios for Bitcoin. Go! Right now, the fear and greed needle sits roughly in the middle of the dial, a neutral zone, about 52 points. That's an important contrast to the recent spikes of euphoria. The market seems to be letting off steam without tipping into panic. This neutrality is tricky. It leaves room both for trend continuation and for a healthy shakeout. In a neutral zone, the crowd usually stops chasing momentum, while larger money likes to use these windows to accumulate. In short, there's no extreme overbought reading, but there's no cheap fear either, which means levels above and below are likely to trade honestly, via liquidity grabs. That works for us. We can prepare level-to-level scenarios instead of playing the coin flip of either the moon or the abyss. The open interest picture is mixed but readable. Total BTCOI remains very high and tens of billions of dollars in notional terms, and the CME share is notable, about 1/5 of the whole market. That tells you institutions are in frame, positions aren't empty. Binance remains one of the heavy anchors by Oway. Bybit is a major player too. Alcax is lower but steady. Day-over-day changes are split, a little trimming here, some adding there. What matters isn't the number by itself, but the combo of price action plus OI dynamics. If price drifts down while OI doesn't deflate, that's often position holding and potential fuel for a sharp reversal. Up after weak hands get rinsed. If we see both price and OI drop hard together, that's long liquidation, which typically runs down to the nearest liquidity shelves below. Right now, it looks more like careful rotation than capitulation. BTC funding across major venues is mildly positive, roughly around 0.01%. Translating from exchange to human, longs are paying, but there's no surcharge, no visible overheating. Alts are patchy. A slight plus here, a minus there, so the imbalance isn't one-sided. For trend health, that's usually constructive. The market can breathe up and down without overloading one side. But remember the simple rule: if mild positive funding is joined by a clear rise in open interest, that's a cue to watch the downside more closely. The market loves to rinse overly confident longs by flushing into the nearest liquidity pockets. On the Binance Perpetuals liquidation map, daily view, we see the familiar rack of posts. Thick stacks of long liquidations sit densely under spot, starting roughly from the 108,000 area and down toward 106,000. These are magnets price likes to slide into when there's not enough fuel above. Above, we have shelves of short liquidations around 112 to 114,000. Farther up, near about 118,000. Fewer, but they're there. The needle of the current price wiggles near one of the most traded centers of the past week, roughly around 110,000. What does that mean tactically? The two most common path of pain routes. First, a quick jab up toward 111 to 112,000, a fast stop grab on shorts, then a sharp drop into 108 to 107,000 where long liquidations cascade. Second, the reverse, first a dip into the liquidity pocket at 108 to 107,000 to reload, then a bounce and later a squeeze of the upper short shelves into 112 to 114,000. Both trajectories are technically justified by the map, so we act from levels, not from guessing. The 24-hour heat map underlines the same magnets. Above price, bright horizontal bands of liquidity sit around 112 and 114,000 with some streaks higher. Below, broad soles are clearly visible near 108 and lower, toward 106,000. The price trace inside the map drifts diagonally lower. That's how it usually looks when the market feels around for nearby lower liquidity and then makes a technical bounce into the upper bands. The simple takeaway: any impulse into one of those bright bands has a high chance of follow-through, as long as there's unharvested liquidity there. To the weekly, the trend line from last March is intact. The white trend line is breathing calmly and we've got room. A local high has formed up top in the 124 to 125,000 zone. From there, the market is correcting inside a textbook Fibonacci corridor. The key marks for us: 0.236, then about 104,400, 0.382, roughly 108,000 and change, 50, did around 111,400, 0.618, approximately 114,500, 0.786, in the vicinity of 118 to 119,000. The current price is around 109,000 and a bit. Essentially, we're sitting near 38.2 and watching whether the week gives a retest of 50. That is the 111,400 area. If the weekly closes above 50, a window opens towards 0.618, the corridor around 114,500. If the weekly close slips below 0.382, the natural target becomes 0.236, the 104,400 area, where all demand zones converge. Only the loss of that area would create a risk to deepen the correction toward the trend line. considerably lower, but for now that's a distant contingency. The weekly story in 2 lines. The long-term bullish skeleton is intact, we're correcting the impulse and doing it by the textbook FIBO. The job is to wait for a clean touch of one of the textbook steps and take risks there by the rules. Now the fun part for entry tactics. On the daily, the volume profile on the right shows the dominant volume of the last big range sitting above spot, in the 112 to 113,000 area, the same place we see the short liquidation shelves. That means if we return to that corridor, resistance will be thick, but a breakthrough it can accelerate fast because that cluster of orders becomes fuel. AVG picture, the 1-day imbalance filled, labeled below price tells us the previous gap inefficiency was already closed. Plus for the bulls, the debt was paid. Above price there are 2 1-day imbalance unfilled, 2 upper pockets of unfilled inefficiency. They bounced it roughly from the 112 to 114,000 area and a bit higher toward about 115 to 116,000. Those are targets the market loves to check after stabilizing from below. Below we see a large 1-day imbalance unfilled, a wide block stretched roughly from around 104,600 up to about 105,000 and change. That's the support basement where strong counter demand usually shows up and where it's convenient to scale in. The current daily candle looks like an attempt to retest the green impulse candle that closed the prior imbalance. That matters. If that retest holds and price starts climbing in steps, the odds rise for a push into the upper unfilled gaps, first into 112 to 114, then toward 115. If the retest fails, a slide into the lower wide imbalance is logical. That same corridor, around 104 to 105,000. That's where we build the trade plan. So the market looks deloaded, and as a rule, when we see a local shakeout of weak hands, the next big move rewards the most patient. Thanks guys for watching. Don't forget to subscribe to the channel, drop a like to support this video. It's kind of important, and I'll see you in the next one.